go with your gut. A lot of people, they look at things, but at the end of the day, you know, I think our gut rarely steers us wrong. If we have a nagging feeling in our gut that something doesn't sound right or feel right, stay away from it.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to the show. I'm your host, Todd Dexheimer. With me, excited to have Jay Patel. Jay, how are you doing today?
I'm great. Thanks.
Yeah, well, appreciate you joining us on the show, and just a little bit about Jay. And Jay, I'll give you an opportunity to dive in a little deeper. But for 25 years, Jay built a massive multi-million-dollar real estate portfolio and had flips and buying the foreclosures, the Airbnbs, the assisted living, 200-unit home community that he built from scratch. But he knew he wanted something bigger, much bigger. So he launched Protex Income Advantage Fund. And that was a fund really specifically designed for what he saw was a big need, and that's helping pre-retirees gain financial freedom. So with that said, Jay, why don't you give our listeners maybe a little bit more about your background, and we'll dive in. Oh, I thought another thing was really cool. You built like the MLS for in India, right?
Yeah, so I'll give you a little background. First of all, I
Yeah,
appreciate you having me on. I checked out a couple of your other episodes. I think you do a bang up job. So,
well,
but
appreciate
first,
that.
the quick correction is the name of the fund is actually PropTech.
Prop tech. What
Uh,
did I say?
I think you said something like PropTech I can't remember, but anyway, it's
Sorry,
PropTech. It's
sorry.
okay. PROPTEX
Yeah,
dot com. Nowadays you can't get a dot com, so we basically have to create our own. I mean, come up with
yeah,
our own name.
yeah,
And PropTech is a kind of a pseudo acronym, if you will. Prop is short for property, T for technology, and EX for our expertise in what we do. So we've incorporated, AI and things like to help us find ideal opportunities. We also, on the technology front, as you pointed out, we built India's MLS system. So my
yeah.
company has done that. It's kind of a labor of love, if you will. I've been working on this project over 10, almost now 12 years.
Wow.
First started on it back in 2014. I actually moved out there in 2015, was based there for about 5 solid years until COVID hit. And then after COVID came back, and I still go back at least 4 times a year,
Hmm.
but not as I don't need to go as often as I used to. But yeah, I mean, believe it or not, 90% of the world does not have an MLS. And if you're in real estate, you know just how important that system is. Without it, our real estate market in America really grinds to a halt because it is that nucleus. It is that central
Yeah.
database in every local geographic market where you can find properties quickly. At least that's on the residential front. Of course, on the commercial front, we've got companies like CoStar, kind of like a commercial MLS, if you will. There's a couple others, but I like CoStar. I've been using them for a while.
Well, but those aren't even like the MLS, the residential MLS is so impressive because there's very few properties that sell outside of it. Where
Correct.
commercial, yeah, you've got CoStar, but it's
Yeah,
nowhere
correct. See other
near.
different sites that are out there, but you're right. The residential is absolutely monopolized
Yeah,
on the MLS because, and without the MLS, residential real estate just doesn't work.
yeah,
I mean, you can't find. Let's look at it this way. People say, "Oh, I can just go to Zillow." Well, where do you think Zillow gets its listings from?
yeah,
You
right.
know, Zillow has a pipeline to every local MLS, and because Zillow understands they're a consumer facing portal. They're a marketing company essentially,
Mhm.
and what they do is take the data that the agents, the licensed agents, upload into their local MLSs, and then they put it up on their site. They're not in the business of trying to maintain what's sold, what's not sold. They just want that data kept up to date. How do they do that? They have a line directly to the MLS. So
Yep.
if I'm an agent and I upload that, hey, I just sold this property within, a short time, it's updated on the Zillow and the Realtor and all the other different sites that, hey, this property's been sold. So that, believe it or not, doesn't exist in foreign markets. So we're absolutely fortunate that we have that here.
So how
And we
has it
still,
been implementing something like that in India, a country that
oh,
didn't
it's a
have it?
challenge. Yeah, it's a challenge. The same problem is, humans are creatures of habit. We don't
Yeah,
necessarily like to change. And
yeah,
even if something makes it easier, the older generation is slower to change. The younger generation, they're ready. They're like, okay, hit me. I want the latest, the greatest. I want technology. But older generation, they weren't ready to move and change. And the real
mm,
estate market really was run when I first got there. I mean, it was it's predominantly run by, middle-aged men also. And like for example, in US, believe it or not, more than 50% of the agents are women, right?
Yep.
In India, that's not the case. It's skewed highly in favor of men versus women in
And
terms of,
probably
that
a
are running
lot of
it.
that old boys club.
It is, and they're ready to always change. But
Yeah.
the good news is now we've made some good inroads. We've got over 12,000 users. That sounds big, but it's not. I mean, in a big market like that, we're in
Yeah.
the middle of now. Our goal is to really 10x that over the next few years.
Hmm.
So that's kind of a side project. Let's put it this way: I don't make any money from that. If I had to make money from that, I would be out in the street. So, but it's something that's got a lot of value. We've already had a buyout offer, which we didn't take. So we're going to continue, stay the road, stay on that same track, and continue to keep building it. Get to a point where we have a significant captive audience actively using it,
Hmm.
and now that's where the real value comes from. I mean, think
Yeah.
about like sites like Facebook or Instagram. They're worthless unless people are actually using it, putting data on there.
Yep.
So the MLS is similar to that, right? If I just
Yep.
launch an MLS, if I have a couple thousand users, there's really no value because I don't have all the listings that in that local market. But once you get that critical mass, people can't live without it because it has everything you need. So I don't want to spend too much time on it, but that's a project that I've worked on. As far as the fund itself, this PropTex fund is something that we launched about a year or less than a year ago, actually now. And my background isn't real estate. Everything I've done for the last 25 plus years is real estate. And everything from, and I know you guys talk a lot about multifamily apartment buildings and
Yep.
value add properties. We love value add. We love buying properties that, need some updating that, we can really increase the value by doing that. And then of course, filling them up. So I've done the apartment building route. Today, believe it or not, I'm actually transitioning from uh, more apartment buildings to uh, senior housing, or more specifically, residential assisted living centers. We love
Okay.
those. We think the potential in that market is tremendous. So, the returns are great. The demand is there. I don't feel that residential apartment buildings can compete with that. Now, of course, there's more intricacies that come in that are involved.
Yeah.
Obviously licensing and things like that,
Yeah.
which are
Yeah. You're
you don't
running
have
a
to worry about in
business.
just a basic apartment, right? If you're
Yeah.
actually doing a business. But we as at the fund, we don't get in the business of actually running the business. So we would say build them and then rent them out,
Hmm.
or to an operator who's an
Hmm.
experienced operator. We can charge a premium, so our rent collection will be much better. Our rent rate will be much better than say if it was just a building of
For
that
sure.
size or an investment. So we're getting a premium because we're basically giving something turnkey to an
Yep.
operator that's going to save them a lot of time from going out and building, getting the approvals and all of that, as well as all the capital that would have to be,
And so
spent.
they're doing like a triple net with you guys.
Yeah, something
Yeah.
like that. Sometimes we could even do a little rev share, but yeah, I mean, we get creative.
Okay.
We're in the process now. I mean, our goal this year is to add two to our portfolio. You say two, it doesn't sound like a lot, but it's a big undertaking. These are fairly big projects, at least for what we are. By the way, our fund is not like some 100, 200, $500 million fund. We're a fairly small fund. We just got going on it
Yeah.
this year. And
Yeah.
I did it because, uh, I've got first of all, a little backstory. I'm almost 55. And like I said, I've been in the business, about over 25 years. Prior to that, I was trading and I, worked on Wall Street. And I can talk a little bit about another fund that I have that also is related to that side of the business. But in terms of real estate, we've done everything under the sun, from short sales to foreclosures to apartment buildings, mobile home parks, and all of them present great opportunities.
Hmm.
But it depends on where you're at in your journey in terms of what really appeals to you, how much time you want to put into it. Some require they're a little bit more hands-on, others are very passive. People think that in general real estate is passive, but that if you don't have a good management company, it's no longer passive. It's gonna,
Yeah.
it's like a misnomer. People think that, oh yeah, I'll just buy a property and sit there and collect rent. Okay, good luck.
Yeah.
So
When it's still not passive,
um,
even with the management company, you've got to make sure you're on top of things. You can't just,
yeah, of
you're not
course, of
going to the
course.
beach and sipping Mai Tais all day.
No, and also, by the way, I mean, eh, you're not going to make a significant enough return
Yeah.
from
Yeah.
just that. So the real money in real estate happens when, like you had pointed out, and I know you guys have talked about in your other shows, is treating value. taking something that has the potential to be worth 5 million, being able to buy it for 2.5 or 3 million,
Yeah.
putting in maybe a half a million, even if you have to three-quarters of a million, whatever it is, and then now you've got a $5 million asset, and you've got some significant upside there. And then of course you're raising rents, and now you get the cash flow to justify it, whereas your
Right.
actual cost basis is much lower. So now you've got a significant return. I love that. And then because you're improving the property, you can also compress the cap rate. And instead of, say, for example, you might have bought it at a 10, you can turn around and sell it
Yeah.
at a 9 or maybe even
Yeah.
less. And automatically that magnifies your return. So that's the reason I love real estate. And the other thing is, it's not just going to get up and walk away. It's not like the market's going to go to zero.
Right.
So if you're with the right people and they know what they're doing, they know how to take a property and improve it. Even small things, like one of the things that I learned is by adding, just a simple laundry facility
Mm.
into a larger complex that may not have one. It's
Yeah.
huge. That
Yeah.
little bit of income that you get that goes to your bottom line, it's almost like net profit. It's pure, profit. So that makes a huge difference to the overall value, because commercial real estate, as you know, and let's talk about even apartment buildings are considered commercial. Um, if you have, if you're able to improve the income, that's a direct goes to the direct valuation, as opposed to other single family homes or even maybe quads or whatnot.
Yep.
So that's
Yep.
why I love it.
Yep. Yeah. I mean, certainly I mean, you can do that with single family homes, with quads and stuff like that, but it's such a big multiple
It's
when you're
harder.
talking commercial.
Yeah, it's harder. And the other thing is, the reason why I'm not a big fan of singles, and even to some degree, quad, I would prefer a quad over a single for sure.
Yeah.
But
Agree.
you're tied to it. It's like having an anchor tenant in a commercial property. If that one
Yeah.
person leaves or that one anchor tenant leaves, your property is in trouble until you can either replace that anchor tenant, or if it's a single family home, you lose a tenant for a month or they stop paying. That could take you 3 months before you can actually get them out, get the property fixed up, and get that re-rented.
Yeah.
You're already negative cash flow for that year, especially
Yeah.
if you are having a mortgage on the property.
Well,
So I'm not a big fan.
I always tell the story of, like, the property where the furnace goes out, and then the roof springs a leak, and then the
Oh,
wash machine, goes out, and it's all within about a 6 month period of time. And guess what happened to your income? You're out now on a single family house. You're probably not making income for 5 years, right? Because you had all those
yeah,
expenses at once.
because all those expenses, right? I mean, if you think about it, people think, yeah, real estate. So unless on average, let's say, assuming that the market's appreciating, assuming it's appreciating at 2.5%. Okay, maybe if you're lucky, 3%. Um, if it appreciates that much, but your return in terms of cash flow on most of these properties, maybe 6%, 7%.
Right.
If you're lucky, you might be as high as 8 or 10%.
Right.
But by the time you've spent all that money, you're not going to see a profit for a while. So you really got to bank on appreciation happening, making sure that you've got a great tenant. I think that's one of the biggest mistakes I made early on, is we were just happy to get the units rented.
Yeah.
Well, you know, that's
Yeah.
that's a recipe for disaster. Just getting it rented means that's like very short-sighted. Okay, great. I don't have
Yeah,
any
finding
worry.
somebody who can
I'm not
breathe air doesn't really help you out.
right.
You gotta
No, you
find the
better
right
make sure,
person.
even if it takes you an extra month or two, you get somebody who's going to be there, potentially
100%.
longer commitment, more solid, less turnover, because that month that you save right now could cost you three or four down the road.
And that goes
So
with
it's
every type of real estate, Jay. I mean,
yeah,
that's your retail, that's your office, that's your single family
absolutely.
home, that's your assisted living. Like, if you spend time and make sure you've got the right type of people, everybody should have a kind of an avatar, a target audience that they're going after for their specific property. Look, if you got a low income housing, you're going to go after a specific resident versus a luxury apartment. That's a lot different person. Same
Mhm.
thing, you're doing residential assisted living. I mean, if you're doing private pay in a luxury market, your target resident is a lot different than a small town, and you might be doing public pay. Um, you got to know who your audience is, and that's who you focus on. I think that's so
Mhm.
important.
I agree.
So tell me about, you know, what excites you about residential? So first of all, let's define residential assisted living. What is your definition that fits what your strategy is for residential assisted living, size wise, and kind of what are you looking for?
Yeah, great question. People think automatically when they think about senior housing, they're thinking about these big box 200, 300,
Yep.
resident facilities. That's not really what I'm looking at. Yes, we could do that as well, but I'll tell you something. I look at it from this perspective. As I mentioned, I'm almost 55 here. My parents are 80 plus. Thankfully, knock on wood, they're in good health and they stay active. But should the need arise and they need to go into a facility, what kind of a facility would I put them in? And I would not put them in a big box. I've
Mhm.
done my homework. I've seen what happens in these big boxes. Yeah, I mean, if you don't have any other choice, you can go to it and it will save you some money in many cases compared to some of these more boutique type properties. But we're trying to appeal to a very specific segment, right? Like you say, who's your avatar? Our avatar is someone who they're retired. It could be a situation where, you know, one of the spouse passed and there's one remaining and they need a little bit of help, but they've been able to save up. They have a paid off house or whatever the
Yeah.
case might be. They can afford to pay, like in the state of Illinois right now, that's where I'm based, by the way. I'm in Chicago. State of Illinois, the average cost for senior housing, like a residential assisted type facility, is just a little less than $6,000 per month, um, which for many people, that'd be significant. It's too
Yep.
much.
Yep.
But our properties that we're focusing on are actually going to be on the higher end of that range, actually a little bit above that. Um, Around $8,000 a month per person. Why would I do that? Why would I build something like that? Well, because number one, the care is far better. You've got one caregiver for four residents, as opposed to in these big boxes, you've got one for potentially 30 or
Yeah.
35, 40
Yeah.
people. So, somebody can buzz and, you know, no one shows up for an hour. Uh, and, that's just not what I would want to put my parents into. So, and I know that there's a decent market for it in terms of the demand, especially everything is all about location. So if you're in the right locations, the right markets, the right suburbs, like in Chicago, there's a number of suburbs that we've highlighted that we know we would want to go into. We've also done our homework in terms of how many of these properties exist.
Yeah. You're going
There's
into you're looking at the demographics. You're looking at
correct,
what can people actually afford.
right?
If you go and build in a market where, boy, I mean, nobody can afford that $8,000 a month. Well, of course, you're not going to do well, right? So
No, right.
certainly you got to do your homework there.
And we don't want to rely on any other external sources of, capital. We're looking at them as the potential resident, make sure that they can afford it.
Yeah.
People think, okay, insurance will help. In some cases it can. There's other, sources you can go to, but ideally it's got to be able to stand on its own 2 feet. Do
Yeah.
you have enough of a market there that can fill up that place? Is there enough of a demand? Believe it or not, some of the properties we've seen, even in our location, they have waiting lists. So
Mm.
$8,000 a month is not ridiculous. In fact, for memory care, the number gets as high as
Oh,
ten to
well,
twelve thousand dollars a month, right?
yeah.
So, and that's absolutely, you know, uh, fair market value.
Are
So
you
that's
doing
what we're
memory
looking
care?
at. We are not yet, but we will be. In fact,
Yeah.
we're going to be opening our first one up here soon. It
Okay.
requires a little bit more, I guess, specialization, if you will.
Yeah,
You
for
also
sure.
need specific type of personnel to help operate it, et cetera. So yeah, that's the next step. I don't recommend anyone if they're going to go into it to go in straight into a memory care right out of the gate.
Yeah.
Get your feet wet, like anything else. Take crawl before you run. But I like residential assisted living centers because they give a great return. There's a high demand. If you look at the next 10 to 20 years, the need for it. Right now, we're at over a million bed shortage right now in this country.
But they're not
Now,
building
we're
it
not talking about
nearly
the
fast
future,
enough.
and we're not open up fast, right? So, and that's only going to increase. So the point is, you got to look ahead. Any investment you make, whether it's in the stock market or here, where's the demand? What is something that's going to be in favor tomorrow, right? You're not going to buy a company that's going to be out of favor tomorrow. That's why all these AI and a lot of these tech companies are doing so well. But from my perspective, this is a market that I think is going to do exceptionally well, and we love the numbers on it. So that's why we're focusing. In the fund, our fund is a three-tiered fund, by the way. So we have three verticals essentially. The first vertical focuses on our long-term assets, and those long-term assets are what we would consider things like residential assisted living. That's a property we're going to hold longer term. Believe it or not, our majority of our income is not actually coming from there. It's a good, stable investment that we're going to be able to generate a decent return from. Our asset allocation is about 40% in long term, about 35% in short term. So what are we talking about? We buy a lot of short sale, foreclosure, tax deed type properties. We love buying a
Hmm.
property 25, 30, 35% below perceived market value, or what it would should be the market value. There you've got a built-in, you got, first of all, you got a big cushion in case the market were to go down or go, sideways. You're fine. You're not going to take a hit on that. I love it because unlike the market, in the stock market, you when you buy a stock, you have no idea if that's going to go up 25 or 30%. You believe. There's a
Yep.
big difference between believing and having a concrete um, uh, as a level of confidence, if you will. In real estate, we know we've got the comps. We know what all the homes in that market are
Yeah.
going for.
Right.
If they're going for 1 million, I'm able to buy it for 650. It's a no-brainer. Even if I have to spend 100, 150,000 into it, I still got that plus 20% plus cushion above that. So we love those deals. We'll buy those even if it's hypothetically a 650 purchase. We're not going to go all cash, right? So the return is going to be incredible. You can buy that property with potentially 20, 25% down. Even if you're in hypothetically, let's say you're all in for 200K with these type of rehabs, we're able to go ahead and, rehab it, put another 150, maybe, X, whatever that amount is going to be required, put another 150,000 in. And that 650 could be now 800,000. We're all in. We can sell it for 1 million. You're making $200,000 on a profit, but my original investment was only 200,000. So the return is fantastic
Yeah.
on that. So a
Yeah.
lot of times people say, "Oh, yeah, you bought it for 600 or put in 150, you all in is 800, you sold it for 1 million, you made only 20%." No, folks. I mean, that's not how real
Made
estate
100%.
works. You made
Yeah.
100%, right?
And
It's
you
how
did it
much
in
did you
6 months.
invest? And you did it in 6 or 12 months even. It's a
Yeah.
fantastic return, but you can't bank on only that. So we have a diversified portfolio. We have a tier one, as I said, is our long-term holdings.
Hmm.
Tier two are short-term. And tier two, because we make more income on the short term, we like tier one because we can take advantage of the accelerated depreciation to offset
Mm.
the gains on this side.
Hmm.
So, and these are properties that we're going to continue to hold. People think, accelerated depreciation is great, but if it's a property you're going to sell in 3 to 5 years, it's not so great because it actually can come back and bite you even worse because you might get potentially, say, $500,000 in accelerated depreciation, but then when it comes time you sell it within less than 3 years or five
Yeah. You got
years,
all the recapture.
you got the recapture,
Yeah.
and then that recapture it could be at a higher rate potentially,
Yeah. Especially if you
so
don't reinvest it.
yeah, so a lot of people I've seen online and people, pitch, hey, go get your accelerated depreciation. It's great. It saves you all this money. Unless you're going to take that property and then roll it into a 1031 in a few years and the roll keep, deferring it. Okay, then it makes sense. Or if you're being able to take that cash, the savings, and then be able to invest it somewhere that's going to give you a much better return, yeah, makes sense.
Hmm.
But otherwise, I'm not a huge fan of accelerated depreciation.
Hmm.
Um, we're all fans of obviously saving money on taxes wherever you can.
Yep.
You want to do that. So for even on that front, I don't know if many of your viewer listeners know this, but there's certain ways, other ways that like one of the things that I'm doing right now, I'm actually getting a residency in Puerto Rico.
Hmm.
Believe it or not, and this is
Like
not for
full,
properties
it'll
you
be
buy
full
here.
time,
No, no. I mean, you have to do it like 5, 6 months a year. But
five
the
or six
point
months a year.
is,
Okay.
yeah, yeah, yeah. But I mean, I'll have a residency. You don't give up your citizenship. You're in the U.S. You still
Yeah.
have that, but it saves me a significant amount of taxes.
Oh yeah.
And it's not like the properties that I buy and sell in the U.S. You still got to pay tax here. There's no way to avoid that.
Right.
But all the management fees and my capital gains that I earn, zero capital gains on that. So I have a fund that I also manage on a trading side, which if somebody ever comes to me and says, "Hey Jay, I'm interested in your real estate fund," I'll tell them like we have these two options. One is great because the real estate fund is giving you essentially about 11%. We have a 11% pref, which is fantastic. That means the first 11% the fund makes goes to you, and
Hmm.
there are no management fees. There's no other split. And then after the 11% is where we make our money, and we take our expenses and everything out of that. So, some people say 11% is not so sexy, but if you do the math, and this is where, we say if you're going to just buy real estate and make potentially 6 or 8%, doing the 11% is way better because if you look at the compounding, it's incredible. If somebody hypothetically were to invest, let's say $100,000 into a fund or an investment that's going to give you 11% on an annual basis consistently, if you allow that to compound, that
Yeah.
$100,000 within 10 years becomes 200 and 85, $90,000. It's
Yeah.
incredible.
Yeah.
almost 3x without the downside, without significant downside risk because it's collateralized by real estate. So 11% is nothing to sneeze at. That's a really good return. But if people are, when they come to me and they say, hey, I've got, X amount, hypothetically say $500,000, so I tell them, look, if I'm in your shoes, I'd probably put 400,000 of that and put it into 11%. Nice, consistent, solid. Of course, there are other factors. For example, how old are they? I mean, if they're looking at retirement or if they're almost retiring, capital preservation is obviously of paramount importance. So you don't want to take a risk with that money. Put it into this thing, nice solid 11%. Then take that 100,000 and put it into our trading fund. I've got a trading fund. You're not going to believe this, but we have Todd a 25% pref. If somebody says like, "What are you crazy?" It's impossible. So there's a strategy that I've developed over the last 10, 12 years that can help me generate almost 50% a year. It's
Hmm.
fully hedged. So it's not like we're out there, we're putting this money in, it could potentially go to zero. But we have not promoted it. This is just something that, I've been doing for over number of years. And we feel like we've completely perfected it. And we just launched a fund for that. I still don't tell people to put all their assets in it, even
Yeah.
though it's hedged.
Yeah.
The bulk of them, I would say, put it into this $400,000, put it there, you get a nice 11%. 20% of that you could put here. You're getting potentially 25%. And remember, a 25% pref means that we don't make anything until you make the first 25.
Yeah.
Then after that, we're splitting it 50-50,
Yeah.
whatever we make after that. And then, so that's how it's structured.
Is that the 11% too? Is it a split afterwards or just
No,
11%?
no. Yeah, that's the 11%. And
That's a
then we
cap.
make anything above that. Yeah, yeah.
Yeah.
So the max you could make on that is 11, but it is
Yeah.
it's a cumulative 11. So let's say, for example, you're in for 5 years and you had 3 years, you got 11%, 11%, 11%. By the fourth year, hypothetically, for some reason it came to 10% or nine, as an example. By the fifth year, in order for us to make any money, so fourth year, we would not make anything because you didn't make 11.
Yeah.
But in the
Right.
fifth year, we would have to give you the 11 plus make up the difference from the
Plus
previous
make up the
year.
difference. Yeah.
Right. So
Yeah.
then we don't make anything until we give you 12 and a half that
Yeah.
year. So, and that, can that happen? There's a possibility it can happen. Let's say we may have
Yeah.
had
Sure.
obviously a sale of a property that didn't give us the kind of yield we wanted, or we're waiting on a sale to happen and the sale doesn't close until the following year. And that's when we actually capture that profit. So it's a possibility, but rarely should that be the case.
Well, I mean, it's investing. You're never guaranteed anything.
Correct. Yeah.
Look at anybody who's invested in the stock market. You're never guaranteed anything, although the stock market has been ripping pretty good lately.
Oh
But
man,
eventually
unbelievable.
it'll go down and people will be all mad because, it crashed and they lost their savings in the stock market. It's just how it goes. So you're never guaranteed anything.
Right. And even in real estate, there's no guarantee there either,
Yeah.
but at least, you know that it's solid, tangible, physical properties collateral rather than, something like a stock that can go up and down significantly. By the way, in our trading fund, we don't trade individual stocks. I'm actually
Mm.
completely against that. I only trade ETFs,
Mm.
and more specifically this Spiders SPY, which is the S&P 500.
Yep.
I love the liquidity. I love the option liquidity, even in the options that I can get, which allow me to move in and out of with size, no problem. Um, and there's enough, volatility and premiums that we're able to collect. So we love it in terms of being able to trade that. And we don't have any individual stock risk where potentially, like we've seen this happen even recently, JP Morgan, one of these other companies, they report earnings. Earnings are great, but they fall one penny short of expectation, and next thing you know, the stock is down, five,
So
six, 7%.
emotional.
It's crazy. Yeah, it's absurd. So we don't want to be tied to any individual stocks like that. It's
That's
nice.
what I love about real estate is not that emotional. Now, don't get me wrong, emotions do play a factor into returns in anything, but it's not like things happen overnight where like it feels like in the stock market sometimes somebody sneezes a little too hard and the stock goes down by, 15%. Obviously, I'm being a little tongue in cheek, but yeah, that it drives me nuts a little bit.
Oh, it has happened though often. I mean, we've experienced it ourselves where the thing just comes down, even though,
Then you're
like you
going,
said, something little, and then in the market, like say for example, it's not even related to that stock. It could just be an industry thing. Look at oil right now. What's happening with it literally is pushing the market up and down every day based on what happens
yeah,
with oil prices.
yeah,
So, any number of factors can significantly influence individual stocks. Whereas you're right, with individual properties, there's a lesser chance of that. And even the volatility that you see, it's not going to be crazy price swings.
yep, yep, yep. Um, what do you think is, the number one hurdle, number one roadblock for anybody looking to invest in, whether it's the your fund, whether it's a syndication, doesn't matter what it is. If they're looking to invest in an alternative asset like your fund, what's the number one hesitation or thing that are holding people back?
Well, I mean, I don't know what would be holding them back. I think much of that might just be familiarity, not being familiar with what that asset is or how it's
Hmm.
structured. No matter what, first of all, I always suggest people to, obviously do your homework before you go into something, especially if it's a foreign concept. Um, I'm not of the belief that you should stay in your own lane. I think you don't grow unless you're willing to expand and actually learn and see
Yeah, I
things
love
out there.
that.
And what we do and what we know is a microcosm. I mean, a small amount of what is actually out there. Like for example, what I told you earlier about my trading stuff, you'd never would have heard of that before.
Yeah,
Like being able to get a pref that's such a high pref. You say, how in the world are you able to do that? Well, we're able to do it because of what we're able to generate in terms of returns. That's not for everybody, but it could be for someone the right person who says, "Oh, I want to take advantage of this, and it makes sense. I'm not going to put my entire portfolio into that, but 5 or 10%, absolutely, I'm happy to do that because the return far outweighs the risk. In terms of being able to get if you're able to get that kind of return
yep, yep.
for a small amount, for a small segment of your portfolio, and it's all. I mean, from day one, I believe in allocation. So whether you have $1 million, $100,000, or $10,000, you shouldn't put all of it in any one place anyway. You're gonna have to decide, where you want it. I remember when I first got my first job, and we had to pick and choose, which funds we want to go to. And obviously, when you're younger, you can take a little bit more risk. So you don't want to go into something ultra conservative. You should be willing to take some risk. And you say, I want to allocate more into this fund versus in this fund, et cetera, right? But as you get older, that allocation, the risk tolerance also changes. So I would say, yeah, as far as people that see alternative type of investments, number one, get familiar with it. Number two, find out who's running it and understand what their true track record is. Uh, Go with your gut. A lot of people, they look at things, but at the end of the day, you know, I think our gut rarely steers us wrong. If we have a nagging feeling in our gut that something doesn't sound right or feel right, stay away from it.
Yeah.
And, so there's an old saying, when in doubt, don't. So at least
I
I apply to that.
I'm going to qualify that a little bit. I agree with what you're saying, but I think that comes down to the fact that you did enough homework on the front end to be able to trust that feeling, right? So some
Yeah.
people follow their gut because they just like something. They see a shiny object and they're like, "Oh, this feels good," and they go after it, but they did no real due
Yeah, I
diligence
know. That's why the
about it.
first thing I said is you got to get familiar.
Yeah,
Get familiar
got to
with
get
it, do your
familiar.
homework, do your due diligence, make sure you fully understand it, talk to the
Yeah,
manager, ask questions. Once you now understand it, like for example, residential assisted living, most people don't invest in them. Most people investing in, apartments,
yeah,
condos,
yeah.
what have you, maybe even some commercial real estate. We've done everything. We've invested in gas stations. We in hotels. Like my last name with Patel, it's kind of a joke, but it's synonymous with the Patel Hotel or the
Yeah,
Patel
yeah, yeah.
Motel.
Yeah.
Indians buy just our culture in this country. Our group, the Indian population, owns, I believe, 80% of the motels in this country,
Is it?
and
It's that high? I knew it was high, but
it's
wow.
it's significant. So and then of course also now the hotels as well. There's a large percentage of and it's like it's not just Indians in that market. I mean, I know that, for example, Indians have also invested a lot into, various different C stores, like convenience
Yeah.
stores, gas
Hmm.
stations,
Mhm.
liquor stores and any number of other businesses that are, a lot of these retail type operations. I've seen, for example, Filipinos that have come to this country, they've done a lot of these salons and things like that.
Mm. Yep.
I've seen a lot of Koreans get into laundromats, and just it's kind of whatever sticks with, and then people end up expanding and they help their families get set up, et cetera. And this is how it happened for the Indian population when they first, as immigrants, when they came here, they'd open up a motel and they'd actually live in the property, service it,
Yep.
do all the work, and then build equity. And then from there, they went from one to two and two to four, and
Yep.
that's how they built their wealth, and
I,
it
I
works.
actually looked at a hotel not that long ago, fairly close to me. We were looking at potentially doing a conversion from it was more of a motel, but from a hotel to a multifamily. And it was an Indian couple that had lived there and they raised their kids there. And now their kids are gone and they're ready to retire and they were selling it.
and
So it
and
was
and
a
they've
perfect
got
example.
significant equity in the property now. It's fully
Yeah.
paid off,
Yeah.
right? I mean, it really makes sense, especially if you're an immigrant from another country that you're, as far as you're coming here now, you buy a piece of property, you work your butt off, and you manage it, and it pays for itself. So you now you have a business, you've got a property, and
Hmm.
it works. So within 10, 15, 20 years, you got a fully paid off asset, and you've been able to hopefully maybe scale that by getting maybe a second or a third. I know a number of families that have not just bought one, but they literally have bought like every hotel or motel on that exit ramp. You get off,
Yeah.
they go this way or
Yeah.
you go this way. They're both owned by,
That,
so they've got that market, that location cornered.
that's great. Um, what's a mistake that you've made and how can you help our listeners?
So one mistake, if I go back to my early days in real estate, I think the biggest mistake I made was I chased the returns. So
Mm.
what I mean by that is we look at these cap rates and it's like looks really shiny, great.
Yeah.
10%, 11%, 12% in some markets. And of course, if you go into certain neighborhoods, you need that to justify making an investment there. But for people who are not experienced, and that's what we were when we first got into this business, we bought properties, for example, south side of Chicago. We
Yep.
bought properties in, downtown Detroit, inner city Detroit. I got great deals. We bought a foreclosure apartment building, which we had a horrible, originally it turned out to be a horrible experience. Thankfully, we got out of it with a profit, but it could have been a disaster. The property we bought south side of Chicago, that was a disaster, unfortunately. We got that property. We had a Section 8 tenant in there. The rent, the cash flow was fantastic. So you're just thinking, hey, if I could do this now 20 times over, 50 times over, we're done. And because you automatically start thinking big, okay, I've done it one time, I can do it 10 times.
Yeah.
The problem is that those tenants are not stable. They're not going to be there forever. And that's where I learned my hardest lesson is you can't just go into these individual single family homes and expect that you're going to make this kind of return and it's going to be consistent. Because when that tenant leaves, and it's undoubtedly going to happen, in our case, the Section 8 tenant we found out was dealing drugs. They also
Lovely.
lost their voucher. They trashed the place. We had to kick them
Yep.
out. We had to, fix up the property. We had, it took a while then to even get somebody else there. We had a shooting that was right in front of our house, literally
Jeez.
point blank. It's scary. I remember one time early January, I went to the property. I used to make my rounds early, like on a weekend. So during the week, I'm busy working. So on a weekend, early morning, I just go and, check up on, there was a vacant property by then because we had gotten rid of the tenant. We were in the middle of fixing it all up. And I went to unlock it. I couldn't unlock it. I thought the locks were frozen because it's Chicago. It's cold weather, right? And I tried really hard. And I finally got it to turn, and then it turned back on me. I'm like, what's going on? And then it occurred to me, somebody's on the inside. And so I called the police, and they said, you better step away. You don't know if they're carrying, packing.
Yeah.
You
On
want to make
drugs.
sure you don't want to go in on. You don't. Yeah, they could be on drugs. You don't know. Wait till we get there. And so by the time they arrived and we finally got into the property, we saw that whoever was there, there was a sleeping bag, a couple of these big bottles of, the beer bottles empty. I think they're like Colt 45 or something. There was a window that was open. They jumped out the back and there was snow on the ground, right? So you could see that they jumped out and took off.
Yep.
But it's scary. These are things that you don't want to be dealing with.
Yeah.
I look at it this way. If I'm going to go buy a property now, I want to buy a property that I know I can feel safe if I had to send a family member to go collect a check. Hypothetically, we don't do collect checks anymore. But the point is, that's the analogy I use. Do I feel it's going to be a safe enough location to send my
Yep.
family to pick up a check? And if they do, if I feel safe, then that's a market that I'm going to go into. So one of my biggest mistakes I made was just chasing returns and looking
Yeah.
at cap rates. Don't just look at that. Look at the entire picture. And because that's going to show you a lot more than just, the money. It's not worth it at the end of the day, just going after the money.
It's Jay, as much as you can say that, so many investors continue to make that same mistake. And I think it's so important for listeners. Look, if you're trying to get into the real estate industry, I get the attractiveness to that because the return looks good on paper. The property is cheaper. It just is. There's a reason for that, by the way. But the property is way cheaper. The returns look really good. And you're inexperienced and you think, well, I can do this, right? Oh,
Mm-hmm.
I'll do that. I can do this. I can handle this. No, the same thing is going to happen. I've dealt with the same exact experiences you've dealt with. You and I could probably trade war stories here for the next 2, 3 hours, and we'd get only through a quarter of them. And I
Mm-hmm.
think any other investor that's done the same thing as us, which a lot of them have, would be in the same page. So if you're listening to this and you haven't been investing in real estate, but you're thinking about doing it, listen to Jay. Don't chase the returns just because they look attractive on paper, because they're probably not going to look quite as attractive when push comes to
When you
shove.
actually, yeah, and then 6 months down the road, a year down the road, it could be a whole different story. So look, at the end of the day, the moral of the story is this should not dissuade you from investing in real estate is absolutely a brilliant move. At the end of the day, you should be investing somewhere. You can't have your money sitting around, otherwise
Yeah.
inflation is going to eat away at it. So
Yeah.
the questions are, where are you going to put it now? Um, and the old adage, you work hard for your money. Now it's time for your money to work for you, and you
Yeah.
should, because especially as you're getting older and you're retiring, you're going to need to rely on that money to be able to support you for the next 20, 30. Nowadays, people are living longer than they used to.
Yeah, for sure.
Modern medicine, more focus on health, etc. So, you need to make sure you have enough of a nest egg. You need to make sure that even while you're retired, you're generating income with that, so that it's not just being depleted. The old, uh, structure used to be a lot of financial planners and advisors would tell you, just do the 4% rule where you're drawing down 4%. Well, nowadays that doesn't really work very well
Mm-mm.
unless you've got a significant amount of money saved up. Drawing down 4%. First of all, cost of living has gone up.
Yep.
So if you're going to just take down 4%, you're going to have to really compromise your overall lifestyle.
Yep.
And I don't think many people want to do that.
Who wants to cut
So
their lifestyle just to
no,
retire?
that's
Like,
when you're
it's
retiring, you're
terrible
supposed to be
advice.
enjoying it, right?
Yeah.
So, and this is why I tell them, like, if you can get into something, for example, like our fund, if it's going to give you 11%. By the way, I didn't talk about this earlier, but we have two classes of shares, and this is why it's good for retired people, because if you can get 11% on a fund, hypothetically, let's say you have $1 million there, that you've saved up now and you've getting 11% on it, you're getting $110,000.
Yep.
And that's not depleting. Your money's still staying there
Right.
while you're getting
Right.
X amount to be able to, so you're not really having to compromise a significant amount in terms of your lifestyle. Which if you don't do that, you just leave it sitting somewhere, it's getting 2 or 3%, and then you're also drawing down 4%. Well, then you have a finite amount of time before that's going to be running out, right? So the nice thing about being able to do this where you're not actually depleting your money is, should something happen to you, you have something significant to leave behind for your heirs. You're not going to be a liability to them right now, or having to, so you can actually support yourself, et cetera. And you're not going to have to compromise your lifestyle, which I think is, for me, is the way I look at it is, look, I'm, like I said, almost 55. I don't think I'm ever going to retire completely, because that's how we're wired. Some people are wired that way. And but I do want to obviously slow down and not have to worry about, what's going to happen if I'm not really going full steam. I
Yep.
don't want to change my lifestyle. So
Yep.
yeah, those things are important.
Yeah, I agree. I agree. Okay, a couple last questions. What's a favorite book you can recommend to our listeners?
Well, I got a few. I mean, I got some in my on my bookshelf there, but I think the one that I would tell you is, I think it's a good one, is Never Split the Difference.
Hmm.
It's a great book on negotiating. I don't know if you've heard of it.
Yep.
Chris Voss. Some nice pointers in there, and I think a lot of times, especially in real estate, if you're negotiating, people tend to, like, okay, let's just split the difference. I'm guilty of the same thing. I've done it before. And
Because
I
it's
say, look,
easy.
let's
It's the
split it.
lazy way
It's
out.
easy. It's easy, but you know what? If you And this goes back to what you said earlier too. If you've done your homework and you know what it is, whether you're buying a car, you're buying a property, whatever it is, you know what that value should be and you know what you're willing to pay. Don't let somebody convince you to
Yeah.
go up. You should be convincing them to come to where you're at.
Yeah.
You should be armed with knowledge is everything. Facts and data is everything. If you don't, that's why I love the MLS. The MLS, especially in real, gives us a plethora of data, and that's what I felt like these other markets didn't have. So no matter what it is you're doing, whether you're buying a car, you're buying a home, you're going wherever, you're negotiating a business deal, you know what they are, and
Yeah.
make sure you know what your facts are, and then you know where you draw the line in the sand, and then don't just be willing to compromise on that. So I think
Yeah.
that's a great book for people to read
I love
and get something
listening
out
to
of it.
that book. It's because he reads it himself, so it's really fun on Audible to listen to.
Yeah, you can do that in the car.
Yeah, it's perfect. All right, last question. What are your three pillars of wealth creation?
So for my three pillars of wealth creation, I would say first and foremost, you've got to focus on diversification. And without that, I think you don't have a good foundation. If everything you're going to put into one place. So number one is diversifying. Um, Two is overall, I think I guess you can't say allocation, diversification is almost the same thing. But I would say knowledge and making sure you know exactly what you're going into in terms of a plan. You know where you are now and you know where you want to be. So work backwards from that. So first and foremost, if you have a plan, you say, okay, I've got 5 years, 7 years, 10 years, I want to be retired. What's my picture? What does it look like? And I need to be
Yeah,
at this number. Work your way backwards from that. And then from there, you can actually define your diversification in terms of where you want to put things, and et cetera. And believe it or not, the other thing has nothing to do with any of the stuff. I think it's more about being in a good place. Because when people always think, okay, wealth can be defined in multiple different ways.
for
I
sure.
feel like, for me, if I'm at a point where I'm comfortable and I'm happy, uh, that's wealth. So if my health is in great shape, so I would say focus on yourself is super important. I do that right now. So if my day-to-day schedule is number one is obviously working out every day. So especially as we're getting older, right? Um, that is going to give me wealth long term in the
Mhm.
sense that my health is also my wealth. Because if at the end of the day, you work your butt off and you make all this money and then you can't enjoy it, and,
Yeah.
you're done by
What's the point?
60, what's the point, right?
Yep.
So I would say first and foremost, focus on you internally, make sure you're in a good place mentally, physically. Number two, make sure you know where you want to be in those 5 or 10 years. Now you work backwards from that and say, okay, in order to get there, where do I need to be invested? How am I going to diversify and be able to get the kind of return that I need to get? So I
Yeah.
would say probably that's the three that I would focus on. It might be different from maybe what you hear elsewhere, but that's important to me.
Yeah, those are great. I love those, and certainly I definitely agree with. Well, I agree with all of them, but I you can't stress enough like that focusing on your well being. Um,
Oh yeah,
what's the
you're in a
what's the
great
point?
place mentally and physically. I mean, honestly, doesn't matter how if you don't need tons of money. You're in a
Yeah,
good place. I think it's more important to be happy and fulfilled in terms of have good people, have good family around you.
yeah, for sure.
Everything else, people focus on the tangible and having things rather than you know having a feeling, if you will, and the
Yeah,
health. So yeah, I think
yeah.
that would, like I said, that would be my number one, and then of course working backwards.
Look, Jay, this has been fantastic. Appreciate you talking about PropTex and just what you've been doing for the last 25 plus years and all the lessons you've learned. How can our listeners get in touch with you, learn about what you got going on?
So our website is Proptex, PROPTEX.com, Proptex. Um, yeah, you can go on there. There's even if you want to speak with me directly. By the way, that's something we always make ourselves super available. It's not like, even though we're fund managers, many times you can't even get and speak with a fund manager. You
Yeah,
talk to their assistants or,
yeah,
assistant, I guess, interim manager or somebody who's young. All of my investors have my mobile number. So, I mean, they literally can call me or text me anytime. I prefer text. But we want to make sure that we're available and accessible. So if they go on our site, if they just fill out this form, they say, look, they want to speak with me about anything specifically. If they have a question about real estate, about a property, maybe about any one of the two funds that I'm managing, whether it be the trading fund or the real estate fund, I'm happy to answer questions. But yeah, those are probably the best way. The website, email, phone, text. We have an Instagram, which, believe it or not, I'm kind of old school there. I haven't really. I'm guilty of not having social media, and I think that's
Yeah.
my kids are amazing at it. I, on the other hand, the opposite. Like I just don't do social media. Um, I do have a LinkedIn, so if somebody wanted to go check out my LinkedIn, has a lot of my experience with respect to my MLS stuff, the real estate business, and everything else that's on there.
Awesome. Jay, again, really appreciate you. We'll put all that in the show notes. And thanks so much for your time. You have a fantastic rest of the day.
Thanks, Todd. Appreciate you having me on.
Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.